Hey everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree Asset Management. We're on the Fed watch where they are in no hurry. And for the fourth meeting in a row, the Federal Open Market Committee decided to keep rates unchanged, leaving Fed funds at a trading range at 4.25% to 4.5%. And, while it may seem as if the policymakers have not done any easing in this cycle, remember, the level for overnight money is 100 basis points below last year's peak reading from where we were from December and through September of last year as we went through that cycle when they did cut rates. So once again, the decision to keep Fed funds at its current level came as little surprise. Fed continues to be sitting back, waiting to see how the economic and inflation landscape unfolds, given the uncertainties that have arisen emanating from the tariff-related developments, obviously. So needless to say, it's not just the Fed, but now the markets, they're still in wait-and-see mode. And for those keeping track, we're now at the halfway point when it comes to the number of FOMC meetings in a calendar year. And interestingly, prior to this just completed June meeting, various Fed officials had been stating the voting members may not have enough data to make a future policy decision, aka rate cut, until September. And that certainly seems to be the case so far, right? And Powell Co have been consistently expressing their opinion that the uncertainty surrounding tariffs had placed a cloud of sorts over the macro outlook going forward. In other words, the Fed sees heightened risks going forward to both aspects of their dual mandate, employment and inflation. And the increased risks for both higher unemployment and higher inflation places the Fed, obviously, right, in a challenging environment. And that's where we sit at the present time, and does not appear as if this cloud's going to be removed anytime in the near future, where a clear-cut decision could emerge during the summer months anyway. So that leaves us with the question: how is the underlying economic and inflation backdrops looking, at least post-Liberation Day, right? So the Fed, as well as the money and bond markets, have now basically had about 2 months' worth of data to analyze since April 2nd. And broadly speaking, at least in my opinion, the macro backdrop still hasn't changed or altered the monetary policy outlook, at least for now. And overall, it looks like U.S. economy will avoid that quote-unquote textbook recession. Remember, after posting that modest negative reading of minus 0.2% for Q1 real GDP, projections for the current quarter are soundly in the plus column. Remember, you got to have 2 consecutive quarters of negative GDP. That brings us back to the dual mandate. And there's no question recent inflation data have revealed a disinflationary trend where the early stages of the tariffs, anyway, that are in effect, have not been passed through to either the wholesale or retail level. So, as Chairman Greenspan once said, CPI is like looking into the rearview mirror. Future inflation reports, then, are going to be integral for Fed decision-making. And as far as the employment situation, the May jobs report showed continued resiliency in the labor markets, but there are a few signs emerging that some slowing, that's all I'm saying here, slowing, not cooling, is entering into the equation. And that's a development we're going to need to watch for sure. So what's the bottom line here is that the Fed guidance continues to emphasize that the macro setting allows the voting members to take a deliberate approach to monetary policy. In other words, let's quote Led Zeppelin here, for those of you who may remember. The song remains the same. The Fed is data dependent and can let the data come to them. And it's against this backdrop, a reasonable case scenario still looks like potentially 1 to 2 rate cuts this year. So I'm going to end it there. I hope everyone has a great rest of the week, and be well.